Well, hey, everyone. Holy smokers, right? My name is Warren Howe and hope you're having a great day as always. Now, we are literally in the last week of 2021, right? Last week of 2021. It's exciting. Everything's going to play out, right? Hopefully, you guys have been controlling your portfolios well. Hopefully, you guys have, been recording your gains. Hopefully, you guys have sort of know what is your portfolio blueprint right now. What is your strategy? What do you intend to actually do? Now, let me know in the comments, guys. And by the way, you know the drill. If you're watching this live right now, click hashtag live, right? Smash that like button, smash that heart button, because hey, it's the last video of the year, right? Might as well to spread the algorithms. Now we are close to 8,000 people in the group right now. Very exciting, which is great, right? Because we can all share, we can have more strategy, we can share more strategies, we can share what we're actually doing with our portfolios. I can see a lot, like tons of comments and interaction right now in the group, which I love, right? So I try my best to actually sort of reply everyone, but I just want to say, thank you, right? Thank you for attending my lives. Thank you for actually interacting with me and sharing me your personal strategies, reaching out to me, dropping me DMs. And I know a lot of you have, added me on Facebook, which is great. So hopefully you guys can have some value of what I personally share. What do I look at? What is my outlook? And as promised, today we're going to talk a lot about that, guys. So again, click hashtag live. You're watching this live right now. Drop that like button, smash that heart button. I'll really appreciate it, guys. So let me share my screen here. We're going live. Where are we? Let me share my screen. Where is the thing? There we go. So 2022 strategy. Now, first of all, I want to highlight that my strategy here may not apply to everyone here. Why? Because we have to assess our own risk profile. Okay, we have to assess our own risk profile. We have to assess our own portfolio blueprint. I've been constantly telling you guys to do that. I personally been doing. Now, just a little bit of what I do. Right, I'm a full-time investor. I'm literally always at home. My work is at home right now, right? So I left my family business in 2019. I started off, my own business, which is for Academy, and also I'm a coach in Jeremy's Financial Fortress. So I have the luxury of not being tied to a normal job. I'm full time, right? That means I also have more time to be actually trying to hedge my portfolio, seeking for more momentum trades, right? And later I'll be revealing what are the types of momentum trades. I also have the luxury of actually going more into thematic plays and obviously piling on to the longer term growth stocks that I want. Yep. So now this is that's why. I mean, why am I saying that? Is because maybe some of you guys are not in this position. I hope you guys are. I hope you guys are what I call living your FU life. I'm living my FU life right now, right? That means I can do whatever I want, right? I'm at home. I love what I do. I love my job. I love researching stocks. I love knowing about like how to keep on constantly growing my net worth, my portfolio, taking care of my family, being a breadwinner, blah blah blah, right? So those of you that do not have the luxury to actually stay at home and just look at the screen all day, that's fine. But what I'm trying to say is that it may not apply to you. Now, also, I'm not a financial advisor. Okay, I'm not your financial advisor. I do not know your risk profile. I know mine. I manage family funds. I manage, a small family office here in Malaysia. So this is what I do. Yep, I constantly want to find gains. Now I'm very fortunate because 2021 I got around 24% year to date. Right, still lower than S&P 500. I'll take it. Right, I'll take it. So that's what I mean by hopefully you guys have actually tracked down. And what are you comparing? How are you challenging yourselves? Right? How are you challenging yourselves? And I've been reading the comments, right? A lot of you actually just started out, right? Since November, which is fine. That means you guys have all the cash, right? Do not simply buy the dip. That's what I'm trying to say. You need to reassess your cash positions. And by the way, guys, you can actually look at, I think Andre, our Financial Fortress team, they actually created a YouTube. Go check out the videos that we have had, right? All the live recordings that I personally had. I talk about portfolio blueprint. What is it? What to look out for? What to assess, right? Assess on monthly cash inflows, blah, blah, blah. So I'm not going to go into that into detail today, but what's important is that I want to talk about what I personally look at, right? So, yeah, hopefully you guys sit back, relax, and drop a comment if you guys have any questions so that we can interact together in the live, right? So, my 2022 strategy. Now, we have to think about what are the potential headwinds. That's first, okay? What are the potential headwinds that will arise, right? What are the problems that might be affecting the market, right? So, obviously, number one, inflation. So, why is inflation is a problem? Why is it a problem? We all already know what's the problem, right? Those of you that are in the market already, there are supply backlogs. Ever since COVID shutdowns, supply backlogs, 3 months of a whole world demand has been kicking up, right? So when supply is actually going lesser, demand is going higher. Obviously, what happens to stock prices? So what happens to raw material prices? What happens to, everything? Consumer price, the CPI is actually going off the roof, 5 to 6%. Core CPI, normal CPI, everything is going up. So will this be a problem? And is it transitory? Now, Jay Powell mentioned that, hey, inflation is used to, right, mention that inflation is transitory. And now he's trying to say, you know what, guys, it's not transitory. Like, what the heck are you trying to talk about? But these are the potential headwinds because, as we all know, this will affect longer term growth stocks. Why? Because if growth stocks are actually not earning money, right, no positive income, no cash flows, then it will take longer because growth stocks are, at the end of the day, future, right? We are looking at the future. So my strategy to tackle this is very simple. Every stock that you are investing in right now, every stock that you are actually, on your radar, what is the path to profitability for these stocks? What is it? PTP, right? Path to profitability. That is what I mean by we can't simply buy the fucking dip. Okay, guys, we can't simply buy the dip. We need to assess and we need to have a buy plan on when are they going to be profitable, right? I forgot to update my, the public account, right? Later I'll be updating the public account. So there's a lot of things I want to share today, and it's going to be quite a value action packed, session. Hopefully you guys stay tuned. Now, path to profitability, we can't lie to ourselves. We need to do projections, right? I constantly been saying this. All of your stocks right now, 10 stocks, what are the projections of each of them? And how long are you going to hold based on your thesis? Okay. Now, SoFi, I always give this example, SoFi, because I'm very bullish on them. Please do not copy me. SoFi, my path to profitability for them, net income wise, is 2 to 3 years from now. That is excluding the bank charter, guys. Bank charter will obviously, expand margins, not compress them. So yeah, this is SoFi for me, 2 to 3 years. I'm okay with that. I can live with that. I can see consumer spending still increasing. The loans are still, dominant. So yeah, inflation will not be a problem. Now, obviously, we need to assess whether or not inflation is a problem for your stocks right now that are affected. But most importantly, if you guys are investing in growth stocks, what is the PTP, path to profitability? That's why we don't simply buy the dips on, I don't know, whatever it is, right? SDC or I don't know, whatever it is. This is what I want to say. Okay, we need a buy plan. We need a sell plan. We need to know how long we're holding for. We need to stick to our thesis that's intact. We can't lie to ourselves, right? As long as it's thorough, then it's all good. Yep, inflation. But personally, my take on inflation is that I do not see this, 2022 will still remain high. Now, 2021, it was affecting on the goods and services. Now it's actually going to, car use rentals and whatnot. I pulled up a website. We can actually look at that later. But my theory is that, okay, inflation will not remain to be like that for 3 years down the road. Maximum is going to be 2023, right? Supply is actually keeping up, guys. We should do our research. Supply is keeping up. So when supply keeps up, demand and supply is actually there, the rates actually go down. So that's a better thing for stocks, right? And number two is the rise of interest rates to match up with inflation. Now, Jay Powell obviously gave a very good, sort of good news, right? That 2023, they will only see rise of interest rates by 2023. Slowly, right? They're going to slowly do that. So what does that mean? And later we will see the correlation of interest rates versus growth stocks versus value stocks. Okay. And just it gives this gives I'm not telling you guys what to do, guys. This is very important. The purpose of me going live is actually sharing what I preach, what I do. But at the end of the day, you control your fate, right? Obviously, you control what to buy, when to buy, what are your strategies, blah, blah, blah. So rise of interest rates, this is a headwind. Why is it? Because, obviously, people will go lesser into aggressive stocks, riskier assets. If let's say, interest rates go up, they'll buy bonds, right? Which is a stupid mentality in my opinion. But, end of the day, this is what people think. Why is this stupid? Is because, interest rates can't give us jack shit. It's as simple as that, right? 2%, 1%, 3% a year is nothing when it comes to stocks or risky assets, right? But anyway, this is a problem. And number 3, Omnicron. Now, is this a problem? It is. There's good thing that, WHO actually revealed that, hey, Omnicron is actually 75% less severe compared to Delta, right? In fact, Omnicron might be a blessing in disguise. Now, I personally am not, seriously, Omnicron, Megatron, whatever shit that comes out, I'm not afraid. Why? Because COVID is actually going to be a norm right now, right? It's going to be so moving forward, and we as forward-looking investors, we should, look at the bright side, right? We should look at the bright side that, hey, this will be a norm. This will be like a flu. We got our boys working at Moderna, Pfizer, right? Working their asses off, AstraZeneca, whatever it is, to come up with vaccines. 2020, similar to how we thought 2020 was going to get worse, 2021 straight away, boom, right? Vaccines coming out, third dose right now. I got my third dose. Hopefully you guys have your dose as well, booster dose. So, I'm not worried about, COVID, right? In fact, I take this as opportunity to buy on dips. It's as simple as that, right? Number 4, Fed tapering. Now, Jay Powell revealed that, hey, Fed tapering, they will double the rate, right? They will double the rate of tapering. And the question is, will this be a problem? Now, in my opinion, I don't like to time the market, guys. Okay? I don't like to time the market, but in my opinion, the market will be getting used to this tapering because there are tons of reasons. Like in the whole year, we look at the S&P 500 seasonality, right? January will be going up from the December Santa Claus rally. Then after that, we can shoot it up, right? S&P 500 seasonality, we can actually know in the past decade how, on average, how did the S&P 500 perform within that year. You can see May consolidating, you can see September another dip, October another dip, and then after that Santa Claus rally, right? What I'm trying to say is the first half of the S&P 500 or markets there are tons of reasons why stocks will go down, right? Suddenly Fed tapering another time, debt ceiling another time, Omnicron. What I'm trying to say is maybe the first half, I could be wrong. But maybe the first half, the market is trying to get used to Fed tapering, right? And, whenever Fed tapering news comes out, oh shit, the market will probably go down. And, that's where if we have a longer term trajectory on the certain stocks that we have already assessed, especially working out the path to profitability, then okay, we can buy the dip as long as your portfolio allows it, right? So I'm not scared of Fed tapering. Why? Because guys, the market is not the market is not dependent on stimulus. It's as simple as that. It's actually dependent on corporate earnings. It's dependent on how the economy is. It's dependent on how money flow is. And, there are very good statistics out there, actually, that right now, America is holding more on cash. There's a lot of money to be dumped in the stock market, to be frank. So that's why I'm personally bullish on the stock market overall, but I need to be cautious. I need to be selective, right? I'm going to be, voicing out my strategy later on. So number 5, the headwinds is that corporate earnings are diminishing due to these factors. Now, obviously, it depends on what stocks. That's the beauty of retail investors, right? We can actually pick which stocks that we want to have. Based on statistics, and I'm not going to pull it out now today because there's a lot to pull out, but based on statistics, on average in the S&P 500, 24 to 26, they have grown 24 to 26%. Now, that's a problem because not all of them are actually earning money, right? But this could also be like, this feels like that, guys, The S&P 500 is up, close to 20+% this year. Does it feel like that? Is it carried by Apple, Microsoft, and the big tech? That, because those are the ones that are actually really earning money, right? Earnings growth, those are the companies that are actually earning. So my point is, will this be a problem, right? Are stocks too inflated? Is there a reason for headwinds? Like, is there a reason more for a seller's market rather than a buyer's market? That's where we really need to assess the corporate earnings and all the stocks earnings, right? Projecting their earnings growth. So it's simple, right? It's simple. To tackle these problems, we all stick back to whatever that we have planned out since any time frame. We can use this strategy. Basically, working out the path to profitability, working out the earnings growth, working out revenue growth on your particular individual stocks, and whether or not we can stomach the volatility if, let's say, suddenly interest rates are rising by 2022. Does that make sense? So what we want to see is the stocks that we are holding. We are assessing their game plan for that. And we want to assess whether or not they can earn, because essentially the stock price will be reflected in due time if, let's say, earnings growth catches up, if revenue growth catches up, and what is the everything, right? Do they have pricing power? Are they the market leader? Do they have potential to be market leaders? Are they going to be capturing the SAM within that space, right? This serviceable attainable market, or the SOM, right? Obtainable market. Can they be actually capturing more of that within that whole niche, within that whole, that time frame? Are they profitable even with a lower capture of the TAM, even with lower market share? Are they a turnaround story? What is the story of your stocks? We need to do this, right? The reason why I'm actually putting this as a headwind is that not all earnings, not all stocks in the S&P 500 is actually earning money, right? So this may be a problem. So number 6, the debt ceiling. Now, debt ceiling is actually a huge problem longer term, right? Why? Because this is the first time in history that they have actually delayed this debt ceiling, right? They delayed the time bomb to 2023, which means we can still run in 2022. But why is it a bigger problem? Is because majority of GDP, right, American GDP, is actually spent on interest rates, right? You got pension funds going into bonds, you got student loans, student funds, whatever it is, into loans, and you got foreign, right? China, Japan buying bonds from America. They're actually obligated to actually pay them interest. So GDP is actually a few hundred B spent on interest rates every year. And that means that there's not enough room to grow as a country, right? To grow infrastructure, to be spending on, to grow basically. So this is a longer term problem, but I will not be worried about this debt ceiling at the moment because the stock market is actually not driven a lot on that, right? So these are the problems that I think. Now, what's my strategy? Okay, what's my strategy? So number 1, again, like I said, we reassess the portfolio blueprint. Okay, seriously, if you haven't, look at it. Right? This should be done yesterday, but if you haven't, take some time to do it, right? This, especially during these holidays or this weekend, look it over, right? What is your portfolio blueprint? How busy are you? Are you a 70-30 guy? Are you working on to 70% long-term, 30% thematic plays, shorter-term revolving cash flow plays? Or are you going to be 50-50 in 2022 because of these headwinds, right? You think that now is an easier way. I mean, there are more reasons for a sell-off rather than buying. It depends on what market, right? So if you look at the Russell, the Russell index, those are comprised of mostly growth stocks. So if you look at that, then maybe there's a reason for buyers to be going up, but it doesn't work that way, right? It depends on earnings, it depends on revenues, it depends on path to profitability, and whether or not we can stomach that volatility, right? It's as simple as that. So I personally am leaning towards more shorter term gains. Now, why is that? Because I'm going to be increasing my shorter term revolving cash flow portion. I want to be raising more cash because, like I said, my thesis is that, okay, maybe the first half is going to be quite rocky after that Santa Claus run up. But, I could be wrong, but I just want to be ready, right? So I'm leaning more towards that. That's why I said this strategy might not be applied for everyone because I have the luxury to do that, right? I'm managing funds. I got cash. I can do that because I'm full time, right? But you guys, if you guys are 100% long-term investors, you already have positions in your longer-term place, you already worked out your buy plans, that's fine. That's a strategy. Because as long as what we said earlier, the path to profitability, right? And whether or not their earnings growth are actually still strong within X amount of years, let's say 3 to 5 years, then you shouldn't change that strategy. You shouldn't change it, right? And your time doesn't allow you to be more shorter term gains, then okay, that's fine. But this is my personal strategy. I want to be more, I want to be, heavier in cash. So how do I do that? Is by, thematic plays. Now I'll be reveal a certain thematic play later. I want to be piling on to commodity plays, right? Because whether we like it or not, commodity plays and commodity prices will still remain intact by 2022, right? Based on some facts and figures, right? So later I'll be showing that in a little bit. But that's what I mean. That's what I mean. Shorter term gains, right? Thematic plays, momentum plays, trading, right? Whether we like it or not, price entry trading, I want to be raising more cash, right? So number two, hands in both growth and value stocks. Now, I revealed that I made a position in Himax. So let me share that right now. I'm fortunate because we started this week, with, I think we started with 3,000 USD. Now we're up 8%. Okay, whatever it is. Because why am I saying that? Is because, okay, that's great. But this is supposed to be longer term plays anyway, right? So I'm going to show you my portfolio here on this, the public account, right? And as I said before, I shared a snippet of some thesis, right, with you guys on Himax, and fortunately, it's crazy. Like, what the heck happened to Himax? I think it went up like what, insane. I'm trying to find out why. I still haven't had time to actually find out why the run up. But if you guys have been, investing in Himax, then it's good for you. Hopefully, you have your thesis done, because ever since we bought, like, damn, Himax went on a roll. Let's see, like 20% or something like that, right? Anyway, that's what it is, right? So this is the public portfolio. This is the update. Why am I actually saying growth and value? Is because if you look back at the previous live, I mentioned about Himax. I said that there are some certain growth catalysts, right? So what are the catalysts? Basically, they're actually, a fabulous player, right? They design chips, they outsource OEM to foundries to actually produce the chips that they have. Now their market share on, touch display for non-iOS tablets is 60% worldwide. That's insane, right? But what's driving, what's more exciting, actually, they are beneficiary of the metaverse, right? They're beneficiaries of actually Oculus, or VR plays, AR plays, not Oculus per se, but this is actually the trend moving forward, right? And what is special also is that they are beneficiary of the automotive sector on touch display. Now that means that, with rise of EV cars, depending on who's their clients, obviously, with rise of, there's actually news came out that there are more demand for Oculus headsets. So this is actually testament that the metaverse is actually coming faster than we think, right? The metaverse is faster than we think. There's a lot of games coming out, a lot of NFT cryptos, metaverse. You can buy land now in NFT. So this is something that I told myself that I'm disciplined to study more about in 2022. I'm going to be studying more about options, NFTs, and going to crypto. But again, building thesis on these momentum trades, right? That's how I raise my cash, right? I wouldn't be, because whether we like it or not, I look at earnings growth. I look at the reality of corporate earnings, right? So metaverse, whether we like it or not, will only take place real money in 3 to 5 years time. I just want to be riding off the hype. So that is the purpose of the shorter term gains. That's what I mean, guys, right? But Himax, when I bought them, they had a PE of 6. P of 6, right? They are profitable. They have positive free cash flow in an environment where high interest rates or high inflation. In an environment where 2022, I see the stock market is gonna continue beating growth stocks. This is actually a safe haven in a way for me, because they have growth catalysts. They are actually a value play. Does that make sense? So, whoever is in, if you guys have built a thesis on, Himax, please let me know in the comments, right? Let me know in the comments. But that's what I mean by having, my hands on both, right? I want to have my hands on value plays, growth plays alike. And I'll keep on constantly finding more and more of these, which is, I'm fortunate to bump this out with my team, but I'll be constantly finding more and more of these, right? So why am I buying SoFi? Because I worked out the path to profitability. I know the game plan. I'm heavily invested. I fully built up my position. If it drops more, maybe I'll, if my cash allows it, I'll keep on adding. But the purpose of it is that's why it's important to have portfolio blueprint, because these revolving cash flow plays, if let's say, fingers crossed, we can have good gains on shorter term plays, then I'll be fueling into the long term, right? I'll be adding more in the SoFi if it dips, right? So that's the purpose, right? That's the whole, that's the whole synergy. Yep. And like number 3, I won't simply buy the dip unless I didn't finish my sentence. I won't simply buy the dip unless I can see a clearer path. I can read the whole story. As long as my portfolio allows it, I won't simply buy the dip. Okay. Well, I mean, I hope my money grew on trees, but it doesn't, right? Cash is limited, whether we like it or not. Even if I'm managing, family office, cash is limited. So I need to be constantly building positions into, the thesis that I built out on, and just reading, maybe stock price laggards, right? Reading what is the opportunity that I can capitalize on because of this event, right? That's where I'm more active in the market, right? And hopefully you guys can actually have the luxury to do so, because the more active you are, the more, we learn about the market, the more we know about trends, social arbitrage, whatever it is, we try to capitalize on these, these sort of moves. Yeah. And obviously number 4 will be momentum and commodity play. So I want to show you guys something. And this is actually pulled out from the leading metals information provider in China. So SMM, supply demand analysis and price forecast. Now, in this whole article, I'm not going to bore you with the details, but the gist of it is silicon metal prices will expect to be ramping up because of the demand. So that means the demand is still strong, right? So in Malaysia, we actually have a platform, and I use this platform. It's awesome. And we talk about, these are actually valuable sharing, right? So what we do is that supply and demand analysis and price forecast of China silicon. There's actually very good, good backed up information that silicon prices will still continue to rise. So don't fight the trend, right? Go with the momentum. That's what I do. So I'll be trying to build thesis on, rather American companies, but in Malaysia, I actually invested in a company called PMB Tech, right? So I'll still constantly, do this. I'll constantly do this because I want to ride the trend, right? Earnings will reflect later based on higher prices. And also I want to show you what Bloomberg Terminal actually showed us. Basically, US silicon metal actually going up like mad. So it's 3,007 per ton, and along the way, in China it dropped, in Europe it dropped a little bit. But my point is, the question is, will commodity prices still remain to be going up? Now, I'm not going to fight the trend. I'm going to go on with the trend and say that, backed up with data, raw materials prices are still going to go up because of heavy demand, right? Especially in China. So if heavy demand goes on and supplies goes down, then obviously, these prices are going to be still going up. Now, when prices go up, what's going to happen to the, company's earnings? This played out exactly, right, with a company called MSC in Malaysia, right? I invested in them. The tin prices eventually saw to the roof. So it was rocky. It went up, it went down, it went up, it went down. Now, I was never a commodity play guy. 2021, like we learn things seriously, we learn new things every time, right? So that's what I urge us all to do. Constantly keep staying in the market, learn more new stuff. That's where I built my thesis on, investing in MSC, right? It's a tin company. They only thrive because, simply because of tin prices, obviously, right? So why don't we grab onto these deals? Why don't we seek alpha by grabbing onto these sort of deals and, be patient with our thesis? Because MSC, we were really patient. We were really patient, right? I can actually show you here, MSC, what happened. Yeah. So, we were really patient. Like, look, beginning of 2021, year to date, you can see this rise up because it's like, it's momentum, and it's basically on what they call, Malaysia, what we call goreng, right? It's actually just push, right? Pump and dump, and then suddenly boom, right? But eventually tin prices still going up, earnings actually reflected, Yeah. So that's why you actually see stock prices going up. So you have to be patient, right? We have to be patient on the thesis that we play out. This is going to be, in my opinion, similar to PMB tech, but hey, that's just my thesis, right? So right out on commodity plays, right out on momentum plays. This is my personal strategy, right? Being more cash heavy because we're going to still see how things play out, how growth stocks are still going to be battered down, or if but whether we like it or not, there are more potential tailwinds, but depends on the companies for growth stocks overall to be going up because they've already been beaten down. Now the question is whether or not they will continue to be beaten down, and this will be the effect of inflation and whatnot. But again, I want to be more selective. It's not 2021 anymore. It's not 2020 anymore. I want to be more selective. I still feel comfortable with raising more cash. I feel comfortable with in and outs, right? So Himax, I wanted to go in and out from Himax, but when that's the beauty about fundamental analysis, right? We constantly keep building thesis on a particular company. It might take months. It doesn't matter. So as you build out, this Himax is telling me that shit. This is a undervalued cheap play, right? It could 2x in probably 2 years. Maybe the stock market is reflecting things earlier. I could get that in 1 year. I don't know. But, this is, and they're actually capturing a good TAM, a good market fit that actually makes sense. So I'm still going to be holding a Himax, right? So what I'm trying to say is my strategy is constantly build thesis on these sort of plays, right? Commodity plays, mixture of value and growth plays. Like there are tons of opportunities in the market. We just need to see them clearly, right? We need to constantly just dig, right? So other than that, what I want to show is that this tweet from Cameron Dawson, right? Like I said just now, I wanted to show you guys the correlation of as to real yields versus how growth and value stocks react to these increase or decrease in real yields, right? So this is actually the PE ratio of Russell in growth index, which is in red, Russell value index, which is in purple, and real yields up and down in black, right? So who is she? So basically she is the who's she again? I bumped into her in CNBC like just recently, right? So chief market strategist at Field Point Private, right? So thank you, Cameron, for actually doing this up. So what this tells us is that since 2018, when real yields actually, by the way, sorry, this axis here, you can see real yields going up by 0.5%, 0.1%, and losing by 0.5%. Going down, right, by 0.5%, 1%. So this is the difference, and inflation is also catered into this axis, right? This graph, and on the right we have PE ratio. Right? What is the PE ratio on average of the Russell growth and Russell value? So what you see here is that in 2018, when rates are actually going higher, that's why you got plus 1%, growth will obviously go in tandem and value both go down, right? Because, higher interest rates, lower stock prices. That's how it works, right? But in 2021, when, the real yield is actually decreasing, right? It diminished, because they have to do that because economy is still growing, right? It's not maxed out yet. Jay Powell said that. So we see growth stocks actually going up, right? Growth PE is actually inflated, but what she's actually trying to point out is value PE has still not seen that upside. Now, there are a few things to comment on this, right? Number one is the reason why value is not really going up because their earnings is not as exciting as growth. Revenue growth, earnings growth is not as exciting. Would you invest in a company in earning $1 every year, or would you invest in a company that's earning 130 cents in the first year, 60 cents in the second year, 120 in the third year, fourth year, fifth year they could earn $5? Yeah, does that make sense? So that's why you could argue that. But the other thing is there more upside on value stocks? See, that's the other question. That's what she's actually trying to point out. That's why I'm sharing with you guys, right? So what do you guys think? Growth? Are you more inclined to go into growth plays on 2022? Are you more inclined to go into value plays in 2022? Let me know, right? Let me know in the comments. And I'm trying to check whether you guys, okay, so no one commented so far, which is fine. But hey, what is your personal strategy? What do you look at in the market, right? So what she's trying to say also is that in 2018, growth PE valuations have gone from 17x PE to 33x today. This another question that also comes out in mind is that in an environment where growth stocks actually seen the better. Now I know growth stocks have been beaten down, right? But overall, the PE ratios are actually going up. So is there more of a reason that these growth stocks will actually go down further? Or will there be, a better percentage chance that value stocks will actually go up? Now, I don't like to time the market. I don't really look at the whole market overall. I spend 80 to 90% of my time researching the stocks that I personally hold and what are the buy and sell strategies on them, right? We mentioned it before just now, path to profitability, right? But in the overall scenario where interest rates are actually more likely to rise up instead of, you can see the black actually going down 2023 onward, 2022, 2023 onwards. So if that goes down, then will growth stocks, growth PE be affected? And value plays will provide, will be that safer haven. That's what she's actually trying to point out. And I do agree. That's why I'm sharing with you guys, right? So that's why I want to have I still love growth. Okay. Again, I revealed this before. I can have the luxury of selling all my stocks today, put in on dividend stocks, and okay, I can be living free, right? But I don't want to do that. There are plenty of opportunities in the market. I need to be staying invested. I want to be compounding. I want to be going to growth stocks because that's what I love. I love earnings growth. I love, capturing market share, good product market fit. So don't get me wrong, I still love growth stocks. But in the overall scenario, this is not like 2021 anymore. Right? This is not like 2020 anymore. Real yields will more likely go up right now. So that might be a good time for us to start early into building thesis on value stocks, right? Or, maybe we can go into more defensive plays. I don't know what it is, right? Whatever it is, we need to look at the stocks right now, build a thesis, build a strategy, and there may be potential upsides on value PEs, right? You could choose a stock from the Russell Growth or Russell Value, and you can actually look at that, right? So that's what I want to share. And inflation, this is CPI. Basically, CPI is actually, core CPI has been going up like crazy, right? All the way until headline CPI is close to 7%. Core CPI is actually below 5.25%. The question is, over the longer run, for example, 3 years down the road, will inflation go down or go up? Now, obviously, it will go down, in my opinion, because supply is going to keep up, right? But, end of the day, and this is the core CPI, right? We got shelter, new vehicles, used cars and trucks and gasoline. Now, these have been, shooting up like mad. That's why you see companies like Avis, right, going up like crazy, used cars. But will this, this trend remain over the long run? I don't think so. Right. I personally agree that, in transit, inflation is transitory in somewhat, but again, we just have to reposition our stocks in a way that, hey, will inflation affect these stocks, right? We have to keep asking these to ourselves. Yep. So that's all for my strategy, right, guys? I'm not really scared of inflation because I know my buy plan on the stocks. I'm not really afraid of rise of interest rates because growth stocks will still continue to plow unless, right, but overall will be affected, right? And obviously, the investing in the stock market, 40% of stock, we revealed this before. We talked about this before, right? 40% of what we call systematic risk is still there. So that's why, whether it be computers, algorithms like trading, whether we like it or not, growth stocks will still be beaten down if rise of interest rates go up. But if you guys have set to hold this, stock for the long run, 5 to 10 years down the road, then it doesn't matter. It doesn't matter, right? Because as long as earnings growth keep up, product market fit keeps up, pricing power, if they have pricing power, these will not matter. High quality growth stocks that have pricing power and market share dominance, they can control the price, right? So hint, hint, Tesla, right? That's why I'm actually bringing it up. Yep. So yep, I won't be, I don't have specific stocks for you guys, but I already revealed some, right? In 2022, I still think that Tesla is going to be killing it. Tesla, by the way, is my highest conviction stock. They're going to be killing it like crazy. You got 2 gigafactories already producing, right? You got FSD already down the road, and robotaxi even getting more clearer, right? They're already profitable, but path to profitability per car is getting more and more clearer. They're investing in R&D, automation, paying off their debts. Tesla is just going to be insane. And, when you want to talk about high quality growth stocks in terms of having a benchmark and what to look at them in terms of their qualities, Tesla is one of them, right? Organic growth, organic marketing, less on sales and marketing costs. You can have operating leverage. They can literally sell a car, a dream for you, and people will still buy. They have pricing power. They can command the price. Man, these are the companies that we should look at in the market, right? Himax, I revealed them. SoFi, I revealed them. Commodity plays. These are my strategy for 2022. Yep. So again, guys, smash that like button. And if you're watching this on replay, click hashtag replay, right? Again, smash that like button, drop a button some love, right? If you want to be talking to me, drop me a DM or drop a comment on this live, and I'll be happy to actually answer your questions. Hopefully you guys got some value out of this today, and I'll see you next year, guys. Check it out. Bye bye.